Should I already start sharing?
Yeah, let me just make a quick announcement and
Okay.
I'll just wait for 1 minute for the people to come in.
Okay, we're live.
So welcome everybody to the American Economic Association session on digital currencies. We have a great team and great speakers here. So we start right away, not to lose any money. Speakers 30 minutes, and then we will have 5 minutes Q&A and 5 minutes question and answers afterwards. So 5 minutes for the panel and then 5 minutes for everybody to ask questions, which you can submit through the Q&A box. Linda, the floor is yours.
Thank you so much. Can you see my screen?
Yes, looks well, thanks.
Okay, perfect. Then thanks so much for putting the paper on the program. This is joint work with Jesus and Harold, who are at UPenn and Chicago. Okay, so the project is about central bank digital currency, and just to put us all on the same page, let me briefly tell you a little bit about CBDC. So in general, the term CBDC is not yet fully defined, not yet set into stone. So the paper today is going to talk about a CBDC in the following sense. We refer to a CBDC as citizens that hold accounts directly at the central bank in form of demand deposits, basically. And institutions that are currently debating on the introduction of a CBDC are all over the world, especially the Bank of Canada, Bank of England, Zürcher Riksbank, and so on. So it's really a very interesting topic currently to do research about and read in the newspapers on a weekly basis, at least. Okay. So the paper, what is the paper about? Generically, the objective of a central bank is to keep prices stable, but as soon as central banks start offering demand deposits to citizens, the central bank basically becomes a financial intermediator and engages in maturity transformation. This means that in addition to the objective of price stability, classic objectives with regard to financial intermediation come into play, such as offering the optimal amount of risk sharing and preventing runs on central banks. So the focal point of the paper today is to analyze how these three different objectives are interacting with one another. And so the main result of the paper is basically we show an impossibility result, namely these three objectives together can never be attained at the same time. It's always required to sacrifice at least one of these objectives in order to obtain the other two. And so I'm going to walk you now through a sequence of three results that altogether make up this impossibility result. But let me mention that the main result of the paper is we show that a central bank can always offer the optimal amount of risk sharing and deter runs on the central bank, but only by credibly giving up the goal of price stability. And so this is interesting because in the Diamond and Dybvig 1983 framework, we have learned that in order to optimally provide risk sharing to agents, banks have to be fragile. And the result today states that a central bank can truly accomplish optimal risk sharing while also deterring runs, but again, only when sacrificing price stability. Okay, so yeah, let me skip the literature for sake of brevity, but the papers that are mostly related are Diamond Dybvig, Sky 2008, and Ellen Kalati-Gale in the chat. The model. So I will first talk about a real model by Diamond and Dybvig, and then we're going to build a nominal model on top of that. So I will first explain to you how Diamond and Dybvig works, and then I will show you the deviations. So we have a 3-time period model, a continuum of agents. Agents are small. At time 0, they are symmetric. each endowed with one unit of a real good. Just think of apples. And now at time 1, agents learn something about themselves. So types reveal, they are private information. Namely, agents learn whether they will live until the last time period in time 2, or whether they essentially will die after the first time period. And so agents that die after the first time period are called impatient. They can only consume at time 1, whereas the patient types, they are late consumers. So these two agent types share a common utility function, a strictly increasing concave and relative risk aversion greater than 1. And so these agents have access to a production technology that allows to transfer consumption across time. So this technology is essentially a storage technology between time 0 and time 1. So for every unit invested at time 0, the technology yields 1 unit of the real asset at time 1, if you liquidate then. If you stay invested until time 2, the technology yields a high return, capital R, and for sure. So what does this mean from the perspective of the agent? Well, at time 0, if these agents are on their own, so if they exist in autarky, they invest their real endowment at time 0. At time 1, they learn their type. If they're unlucky, they are impatient, they instantly have to consume, so they need to liquidate the technology and essentially only have 1 unit of the real good to consume. If they're lucky, they are patient and stay invested until time 2 when they consume this very large payoff. Now, what Diamond the Pig show in this framework is essentially all agents would like to insure one another at time 0 against the risk of being the impatient type. And how do they do this? Well, this can occur in form of contracts that are offered by private banks. So private banks collect all the endowments at time 0 and invest in this technology. And then if an agent at the interim stage learns that she's impatient, she can walk to the bank and demand a real return x1 star, which is strictly greater than 1. So the optimal amount of consumption at time 1 is strictly greater than 1. Now, this is good and bad news because banks can offer these optimal contracts. And if it is the case that indeed only impatient types walk to the bank and demand x1 star, then this allocation can be implemented. But we know from the technology that if all endowments are invested at time 0, at time 1, the overall measure of goods that are available is not 1 to all agents. So there is basically a panic equilibrium where also patient types walk to the bank and demand x1 star. The bank cannot pay x1 star to all agents, and this is then called the bank run equilibrium. Now, the paper today is going to show that if the bank is a central bank that can control the price level and offers not real contracts, but nominal contracts, then the central bank can basically exploit the wedge between real technologies, so real investment and nominal contracts, in order to steer the depositors' incentives such that the run equilibrium cannot occur. So the price level will be a strategic tool today. So now, how do we do that? Okay, so nominal contracts. In the paper, the central bank is a strategic player. She is going to offer a policy that is a triple MYI. So let me explain this policy to you on the go. So how does the nominal contract look like? At time 0, the agent is again endowed with 1 unit of a real good, walks to the central bank, hands over the endowment of a real good, and receives in return a promise of M units of CBDC that you can spend at time 1. At time 1, then, the agent learns her type and needs to decide whether to spend or not. If she spends, she's going to walk on the market with this quantity M of CBDC and will shop for real goods. If she decides to spend rather late at time 2, then at time 2, she's going to spend M times 1 plus I, where this is the nominal interest rate set by the central bank as part of the policy here. Okay, so this is the perspective of the individual agent. And now how does this look like from the central bank? At time 0, all agents walk to the central bank and hand over their real endowment, their real goods endowment. The central bank collects all these goods and invests all of them in the long technology. And now at time 1, these agent types learn their types. They decide whether they want to shop now or rather later. And the central bank then observes aggregate spending behavior. So this here is an equilibrium object. The central bank observes the measure of agents that would like to go shopping, and only then she liquidates a certain fraction of the technology. The central bank then uses this fraction to sell these goods to the agents at a price P1 that clears the market. At time 2 then, so this is the fraction that was liquidated by the central bank. There is a remaining fraction 1 minus y that earns the high return capital R in the long investment. The central bank at time 2 sells this quantity of goods to the agents that wanted to shop late at a price P2 that again clears the market. Okay. I talk about market clearing. How does this look like in formulas? So N is the endogenous measure of agents that go shopping at time 1. Each of them spends M units of CBDC. So this is the aggregate amount of CBDC that is put on the market at time 1. This quantity of CBDC then meets goods Yn, and the price level P1 is such that the value of these goods equals the quantity of spent CBDC at time 1. At time 2, the exact same thing happens. So there is a measure 1 minus n of agents that go shopping late. They each spend this quantity of CBDC on goods R times 1y, 1 minus y, and then the price level P2 again clears the market. Now, let's have a look at these price levels. So if you solve these two simple equations for the price level, we see the price level at time 1 is just the endogenous amount of spending divided by the liquidation policy of the central bank. And so recall that spending behavior is strategic, at least for the patient types of agents. So these price levels at this point in time are flexible in the spending behavior of the agents. And recall that traditionally the central bank's goal is to keep these price levels stable. So we already see here that for the central bank, for keeping the price level stable, she will have to be very careful in observing aggregate spending and then here plugging in the goal, the price level goal. Okay, so market clearing. Now agents are strategic, so they are selfish, and an impatient agent would always spend at time 1 because she only cares for consumption at time 1. But patient agents, they can really think about whether they rather spend at time 1 and earn this individual real allocation, y over n, or whether they rather would like to spend late and thereby earning this real allocation here. And so just really to show you the key mechanism in the paper, the real allocation to an agent at time 1 versus time 2 crucially depends on aggregate behavior by all depositors in the central bank and the strategic liquidation by the central bank. And the timing is really essential. The central bank first observes spending behavior here and then liquidates a certain fraction of the asset. This means the central bank's liquidation policy is really a strategic tool here in order to twist the real allocation at time 1 versus time 2, and therefore impacting the incentives of agents to spend or not. And this incentive of agents to spend or not is going to be reflected in aggregate spending behavior here and here. Okay. So what's an equilibrium? We say a commitment equilibrium consists of aggregate spending behavior, a central bank policy, so supply M, liquidation policy Y, and nominal interest rate I. These take, so liquidation policy and nominal interest rate take as an argument the aggregate spending behavior of the agents and price levels such that individual spending decisions are optimal given central bank policy and the price level. Given an aggregate spending behavior by agents, the central bank is going to liquidate the according amount of the asset and set the nominal interest rate that she announced. So just as a reminder, the central bank announces her policy at time 0. This part of the equilibrium simply states that the central bank fully commits to her policy and really taking as given the spending behavior by agents is going to go through with her policy and the nominal interest rate. And last, given spending behavior by agents and the policy realization, the price levels will have to clear the market. And so the insight is really So the price levels in this equilibrium definition, they will flexibly adjust to the spending behavior by the agents and the central bank policy. So at this point, there is no price stability imposed, not yet. All right. Good. So we define a run on the central bank as the incident that also patient agents are spending. So generically, since the central bank offers nominal contracts, you could think of a run can generally never happen because the central bank controls the price level and so on. So the question is now, why would patient agents actually spend rather early than late? Because recall that they are rather interested in late consumption. So we have to find out under what conditions is it an equilibrium that only the impatient types are spending, and under what conditions is a central bank run in equilibrium. So for finding that out, we simply look at the incentives of patient agents. So an equilibrium where only impatient types are spending requires that, conditional that only impatient types spend, the real allocation at time 1 has to be lower than the real allocation at time 2. And that's simply because as the agents learn that they are patient, they observe the central bank policy and then make their strategic decision whether they spend rather late or early. So given low spending behavior, it has to be optimal that it has to be the case that the late consumption is higher for the case that impatient agents are only spending. So when would a run be in equilibrium? Well, conditional on all agents spending, for a run to be in equilibrium, the real allocation at time 1 has to be larger. It's basically the reward for running early for patient types. So the question is now, how can the central bank twist these real allocations here? And I've written these real allocations here below. It's simply the central bank is going to observe aggregate spending behavior and then choose a liquidation policy that shortens the goods supply at time 1 and therefore increases the goods supply at time 2. This allows the central bank to make the real allocation at time 2 rather large. Okay, so how can we implement that the social optimum occurs in equilibrium? Well, we have to do two things. First of all, given that spending behavior is low in the sense that only impatient types spend, the central bank has to liquidate a sufficiently large fraction of the asset such that the social optimum is really attained. So for low spending behavior, she has to liquidate a sufficiently large fraction of the asset. Now, the other way around, the central bank has to deter now patient agents from spending, and she does so by, if she observes that spending behavior is too large, if she sees that also patient types are spending, she has to take care that they will regret that. And so the way to do this is to take care that the real allocation at time 2 is larger, because then as a patient agent spent early, she made the wrong choice ex post. Okay, so we call a liquidation policy run deterring if it satisfies that conditional on also patient types spending early, the central bank shortens the goods supply at time 1 and therefore takes care that patient agents regret their decision. But the central bank, recall, she commits to her policy already at time 0. Therefore, as she announces such a run deterring policy, and if this announcement is credible, patient agents would never spend early given such a run deterring policy. So this is an off equilibrium path threat that deters runs ex ante. Okay, so we are now ready to show you the first part of the trilemma. Every policy choice where the central bank liquidates a sufficiently large fraction of the asset, given that only impatient types are spending, but if also patient types are spending, then she shortens the goods supply sufficiently so that patient types regret their spending behavior. Such a policy deters central bank runs and implements the social optimum and dominance strategies. Yeah, so these are two objectives that the central bank has attained. Now here's the flip side. if you shorten the goods supply so much, this requires that the price level at time 1 is large, and in particularly flexible. So the price stability goal cannot be attained. It's rather that the central bank uses the inflation threat to achieve her other goals. Okay, and so one thing that is interesting is in Diamond and Dybvig and in many papers on bank regulation, the way that you deter runs is by suspension of convertibility. This means that at some point when there's a run on the bank, the regulator or some institution intervenes and stops agents from withdrawing or from spending here. But this is not the case because the central bank does in no way interfere with the spending behavior of agents. It's rather that she uses the liquidation policy. So she shortens the goods supply. And this is how she can implement her policy and implement the no-run equilibrium. Okay, so 10 minutes left. Okay, so overall, what this shows is that in a nominal world, central bank runs manifest themselves in a different way, namely potentially in form of runs on the price level. There are two issues with this so far. First of all, what I've shown you requires a strong commitment by the central bank to her policy that she announced at time 0. And naturally, with such policies, there are time inconsistency problems. The other issue is that generically, central banks care for price stability. And we have just seen that the central bank, for deterring runs, has to sacrifice the price stability objective. So now, what we basically do is, so I've shown you that these two goals can be attained when sacrificing price stability. Now we go the other way around. We're imposing price stability, and then we will see whether we can attain optimal risk sharing or whether the central bank will be prone to runs. Okay, so how do we define a notion of price stability? So we say a central bank policy is P1 stable at some goal PR if the price level at time at time 1 is stable at the goal, no matter how many agents decide to spend. Yeah, so we impose a constant price level at time 1 and potentially even at time 2. What does this mean in terms of market clearing? Well, the central bank still observes the amount of aggregate spending and then sets her liquidation policy. But since she now has a price stability goal or objective, she basically puts the left-hand side here equal to a constant. And we see immediately that this imposes constraints on the central bank's liquidation policy. But what kind of? Okay, so we change the equilibrium notion and so on. But okay, so a P1 stable policy by the central bank requires that she liquidates assets in a constant proportion to aggregate spending. Yeah, so the larger spending behavior, the larger the fraction of the asset that needs to be liquidated. And so this has to be the case for all possible spending levels. But so now here comes the drawback. There is a feasibility constraint because the central bank can never liquidate more than the entire asset. So this fraction here is bounded from above by 1. And this instantly means that the real allocation that can be attained to agents that spend early has to undercut 1. And this is bad news because we know that the social optimum exceeds 1. So we already have here the second part of the trilemma, namely that under a P1 stable policy, the social optimum can never be attained. The good news is that this reallocation at time 1 is so low that also central bank runs would not occur. Let me briefly show you in a graphic how these price stable policies look like. So you have here on the x-axis the spending level. So constant proportion, constant liquidation means that you are here on a straight line. You can basically attain all these slopes here below, but you're bounded from above by a slope of 1, the 45-degree line. Yeah, that's because of the feasibility constraint. If you go, for instance, along this line here you hit full liquidation of the asset, meaning that for higher spending levels, you can no longer liquidate in constant proportion. And the bad news is that in order to attain the social optimum, we would need to liquidate somewhere here. Yeah, so this is not possible. Okay, so that's the second part of the trilemma. Now, the question is, coming back here, so full price stability appears to be a too strong concept. Yeah, so we cannot attain the social optimum under full price stability. So we kind of want to reach this point here, which means that we are aiming for higher slopes. But at the same time, we know that due to the feasibility constraint, since we can never liquidate more than the entire asset, we will kind of potentially hit full liquidation. So there would be spending levels for which we would need to liquidate the entire asset. So let's define such notion of price stability. We say that a central bank
Linda,
policy,
you have 5 minutes.
Thank you. A central bank policy is partially price stable at some level P bar if either the price level is at the goal or if the central bank is required to liquidate the entire asset. And so in terms of how does this look like? So here are low spending levels for which indeed the central bank can liquidate at a constant proportion. So the price level would be stable along these spending levels. And for such low spending levels, in fact, the social optimum can be attained if only few agents spend. But there is a critical spending level NC for which the entire asset has to be liquidated. And from here on, as spending levels increase further, the price level is no longer stable. There is more of bad news because if you're required to liquidate the entire asset at time 1, this means that there's no investment left over for agents that spend late at time 2. So they receive a real allocation at time 2 of 0. And if they anticipate that, if they believe that spending levels will be high, this is going to cause a run on the central bank. So we are back to trilemma part 3. Under a partially price stable policy, runs on the central bank reoccur. So there are two equilibria, the run equilibrium and the run equilibrium. In the no run equilibrium, the social optimum can be attained and the price level is stable. But under the bank run equilibrium, the price level is not stable. And yeah, we have a run on the central bank. Okay, so this completes the trilemma. I will conclude and then I will give you a brief forecast of what else the paper does. So first of all, I've shown you a nominal banking model for a central bank and its CBDC. We show that central banks naturally can always deliver nominal obligations, but central bank runs can still occur either in the form of rationing or in the form of runs on the price level. And these runs on the price level are, we believe, new to the literature. So we have shown an impossibility result, which we call the CBDC trilemma. The implementation of the social optimum can be done can be implemented in dominant strategies. So runs do no longer occur, but price stability is lost. If price stability becomes the foremost objective of the central bank, then under full price stability, the social optimum cannot be attained. In order to attain the social optimum, but remaining a notion of price stability, the runs reoccur on the central bank. Now, let me tell you that in the paper, there is an extension section where we allow for private banks to coexist with the central bank. And that's interesting because you saw that it's here in the paper very crucial that the central bank has full control over the goods supply. As soon as private banks also invest in real assets, potentially banks can undermine the liquidation policy of the central bank. So what we do show is if there's a centralized goods market, first of all, there's a strong incentive for the central bank and private banks to coordinate their liquidation policies, simply because if private banks put too much product on the market, this might cause a run on the central bank. Vice versa, if the central bank puts too much product on the market, this can cause a run on private banks. So the coordination incentive is there, but sometimes coordination is not possible for various reasons. For instance, regulation that demands private banks to liquidate in a specific kind of way assets. So what we show is if coordination is not possible, then still central bank runs can be deterred if the central bank has a sufficiently large market share in the deposit market. All right, I think I still have 1 minute, but okay, I will leave it here. Thank you.
Thanks a lot, Linda. So are there any questions? Let me perhaps throw in one question on my own, is that perhaps if you could elaborate a little bit, what does it mean that you shorten the supply at time one? Because in the real world, CBDC doesn't give you any right to buy any apples or anything. You can't convert it to anything. There's no convertibility in anything. Mm-hmm. And you can also change the interest rate at time one. I guess you can hike the interest rate. Is this what's going on? Or?
Yeah, so the nominal interest rate, in fact, only plays a subordinate role, similarly to the money supply. So what really is crucial for deterring the run on the central bank is the liquidation policy. So recall that in the model here, the central bank runs the entire real economy. She completely controls the goods supply at time one and time two. And it's simply because if many agents decide to spend their CBDC balances, but the central bank decides to only put very little product on the market, the price will be huge. So agents know that if they go shopping, and if many agents go shopping all together, but there are only 3 apples in the market, the price for apple will be gigantic and you will not be able to afford many apples. So if you know this in advance, before you make your spending decision, you would rather decide to spend late. And this is what the central bank does.
But if the central bank offers a high interest rate at that point, and then the price level is, it doesn't work through the interest rate, the nominal, I just hike the nominal interest rate?
No, it does not work through the interest rate. It works through liquidation policies.
I mean, we have not, we have taken the nominal interest rate off the table in period one, but there's a discussion about this in the paper, and you're right that if people would start spending a lot in period one and the price level would go down, then the central bank could just, charge, essentially take people's money away, right, in reaction to this run, which sounds very different from the typical, central bank strategy in face of a run. So if you think that through, I mean, it's possible, but it doesn't look like anything the central bank would currently do. But there's a discussion about that possibility in the paper.
Are there any further questions? And I don't know, can I invite? So if you want to raise your hand or something, any of the participants or panel members first?
Yeah, so I was just going to ask, so this is a model where the value of the currency is, if I understand right, is backed by the goods the central bank has on hand and not, for example, by future taxes. Have you thought about, if there was future tax revenue available to the central bank, would that help relieve the trilemma?
So agents should just think about what they can afford with their kinds of money. If you have taxes, you would need to additionally deduct from interest rates and so on. But essentially, what agents really look at first is how much priority do they get if they spend early or late. Potentially, if you spend late, then there's a different kind of tax rate than potentially what you spend at time one. But again, taxes are nominal, and yeah, so the mechanism runs over the real allocation, and from then on, you could work backwards. That might change something, but right now I'm not sure.
Yeah, okay. I guess maybe another way to state my question is there's strong parallels with the Diamond Divvig literature here, and I was trying to think of what would be the parallel of Diamond Divvig deposit insurance, which is where the effectively the government has some way to raise revenue, and then they just guarantee the value of the deposits in the late period. Is there some way here the public sector could guarantee the value of the currency, the spending, the real value of the currency in the second period, and therefore preempt a run in the first period?
May I take a take on that, Linda?
Yeah, sure.
So the thing is, you need to be careful because deposit insurance only promises you nominal payments in the real world. The FDIC only promise they are going to give you 100 green pieces of paper. They don't promise you they will give you 100 real goodies. And you could imagine that governments that face banking crisis, as they have often done, will print a lot of money and give you the nominal value, but not the real value. So in that sense, I think that we actually have something that looks a little bit more like the real deposit insurance that we see in the world, which is nominal, not in real terms.
Yeah.
And let me add another thing. I mean, the nominal contracts are always satisfied, right? So that it's always the real counterpart. And of course, you could have the people buy all the goods in period one if there's a run, and then tax these real goods away, put them back in the central bank, so effectively leave them in storage, right? But that would undermine the whole system. I mean, it's true. You could introduce these channels, but they probably don't look like anything like deposit insurance. It's almost the opposite, right? That you are.
Yeah. Yeah, okay, just to be clear, I wasn't suggesting you have deposit insurance here. I was just trying to think of a mechanism in your model that would use that would be similar to deposit insurance as Diamond and Divik wrote it, which is exactly what you said.
I think the difficulty is that this is the aggregate economy, right? There's with deposit insurance, there's a deep-pocketed guy out there who can, provide these resources for an individual small bank. So this is a system-wide run, and resources have to come from somewhere. And that would be an interesting extension to consider for sure.
Yeah.
So I would like to open it up to any participants. I think it should be feasible. If you raise your hand, I will unmute you if there's any question. Otherwise, I would like to know what's special about CBDC here. What makes it a CBDC rather than some other? Is there any CBDC speciality, or is it just a regular currency?
In the paper here, it's more the idea that once central banks offer CBDC, they have to engage in maturity transformation, meaning that on the one hand, they offer something like a demand deposit contract to citizens, and on the other hand, they have to start investing potentially in the real economy.
No, but you can also have some outside money. It's just a bubble. It's nothing. You have to invest. So you're saying if you issue CBDC, you have to hold some real assets?
Yeah. Also, Marcus, the good thing about a CBDC is you can have negative nominal interest rates, which you cannot do regular fiat
That's important
currency.
for the paper, or?
Yeah, because you can always stuff your metrics with the cash, but you by the CBDC by definition you cannot. So that gives the central bank much more room to implement a lot of different allocations.
The overarching issue here really is that
even harder. The dilemma would be much easier to prove than with CBDC. That's what you're saying.
Yeah.
I mean, it's a matter of degree, but the overarching issue is that with CBDC, people might start treating CBDC as a substitute for checking accounts, right? So you might see people that otherwise might have gone to banking using CBDCs to do, all kinds of payments and so forth. So that's sort of the world that we envision, and I think many people are thinking about this. So now all these issues that arise, checking account is backed by financial intermediation. So if that's happening, then CBDC needs to be backed by financial intermediation. And that's what the paper is trying to think through. I mean, with cash, people don't treat cash so much as a substitute for checking accounts.
Could I ask about the negative interest rates? So when would you want to have negative interest rates under this optimal insurance scheme? Could you just expand a bit more on why that expands the useful possibility set here in this model?
In the paper, it actually shows, so the way I present it right now is as if all agents are basically forced to have a CBDC account. One thing that we show is as soon as you have a negative real interest rate, you will lose voluntary participation. So it's not going to work then. Yeah, so there are no negative interest rates.
Are there any questions from the participants? I saw that most of them Harald answered already in the chat box or in the Q&A box. If there are no further questions, I would say we move on to Todd for the second paper. Todd, the floor is yours. Thanks a lot, Linda and Harald and Jesus and Daniel. And Todd and Daniel are next.
Okay, is my screen sharing properly there?
Perfect.
Yeah, okay. Well, thanks very much for having us in the session. As you mentioned, this is joint work with Daniel Sanchez here. So So Linda's already introduced the topic, but let me just go ahead and reiterate some of the points she raised. So a lot of central banks are talking about issuing digital currencies, and there's this working paper by the BIS where they did a survey. They asked a bunch of central banks, are you considering in some form the consequences of issuing a digital currency? And more than 50 central banks from around the world answered yes to that question. And they also asked them about their motivations, and there are a variety of answers. Some of the motivations are about a desire to improve on physical currency, so offer people a more efficient means of payment, and perhaps through that sort of promote financial inclusion by providing this better instrument to people who are currently, for whatever reason, excluded from the banking system. There's some answers about improving the effectiveness of monetary policy and maybe about preempting the growth of private digital currencies like Facebook's Libra proposal, which is now called Diem. And the ECB actually, for a major central bank, issued a report on the digital euro back in October, and they stated sort of their primary motivation as being ensuring that consumers continue to have unfettered access to central bank money in a way that meets their needs in the digital age. Okay, so whatever the motivations are, though, however, the issue of raising a digital currency clearly raises some concerns. And in this paper, what we want to do is focus on one particular concern, which is kind of obvious when you think about it. That is, suppose that a lot of people who are currently holding funds in banks, in checking and savings accounts, and they decide to shift those funds to a new central bank digital currency. Well, it seems like that might drive up the funding costs of banks. It might have negative implications for bank lending and perhaps for aggregate investment. And this issue is commonly raised in the policy discussions on CBDC. So here are just a few quotes from the BIS. A flow of retail deposits into CBDC could lead to a loss of low cost and stable funding for banks. From the ECB, a consequence could be higher interest rates on bank loans. From the Bank of England, so at what point do the benefits of a digital currency get outweighed by the negative consequences of the central bank disintermediating a large part of bank business models? And in fact, The Economist magazine just last month had a short article on exactly this issue, which they called the disintermediation dilemma. So in response to this concern, some policymakers have suggested a CBDC needs to be as similar to physical currency as possible. And this could be achieved, for example, by somehow placing limits on the amount any individual can hold, making it hard to hold very large balances. Or you could even require both parties to a transaction to be physically present. So if, for example, you have to touch smart cards in order for a value to be transferred. But these approaches kind of seem like, they might be throwing the baby out with the bathwater, so to speak. And in addition, when you think about the central bank disintermediating private banks, well, that sounds bad. But another way to think about this issue is to just say, well, wait, the central bank's just offering a medium of exchange that is improved over physical currency in some dimensions. It can be used in a wider range of circumstances, including maybe online transactions. It can potentially bear interest. And what could be wrong when you think about it that way? What could be wrong with the central bank offering a better medium of exchange? In fact, it seems precisely like a step towards Milton Friedman's optimal quantity of money, which seems like it should be a positive thing. So the answer to the question of, is this disintermediation concern a problem, and should central banks issue digital currency? The answers to those questions, I just want to argue, are not so obvious. We need a model to sort those out. And that's what we try and do in this paper. So what we're going to do is we're going to construct a model in which bank deposits are used as a medium of exchange. And because they can be used as a medium of exchange, under some circumstances at least, they provide banks with a low-cost source of funding, in a sense we'll make precise in the model. And then banks are using this funding to invest in productive projects. Okay, and so then we're going to take that model. We're going to introduce a central bank digital currency, which is going to correspond to an alternative medium of exchange, which can potentially compete with cash and/or bank deposits. And it can pay interest at a rate chosen by the central bank. Okay, and then in the context of the model, we just want to answer the question, derive conditions under which the CBDC does in fact raise welfare, and at the same time study the optimal design features, in particular, what types of transactions should the central bank encourage its use, and how should the central bank set the interest rate. What we're going to show is that the optimal policy may involve some disintermediation of banks, even though it is raising welfare. And one of the sort of key takeaways from the model is going to be that the interest rate on the central bank digital currency is a new policy tool, and it's a useful policy tool for managing some of the trade-offs the central bank faces. All right, so there's actually an interesting, fast-growing literature on this topic. So Linda already gave us one of the papers here. There are a bunch of others. I won't spend any time here. I'll just mention there's a short and sort of nice review of some of this literature by Carapella and Fleming in a recent Federal Reserve Board note. But we're still at the beginning. I think there's still a lot to be learned here. And so let me just jump into the model and sort of talk about what we do. So I'm going to give you a sketch of the model. Then I'm going to talk about equilibrium in the current situation, the world with no CBDC, all right? And then talk about what happens in the model when you introduce a CBDC and what determines the optimal policy. So I should mention, I know some of you have seen this paper before, but this last part is new and kind of interesting. So even if you've seen it before, please bear with me for a bit. All right, so the model. So it's a dynamic general equilibrium model in the Lagos Wright tradition. So we have the alternating centralized and decentralized markets. The usual information frictions imply that there's in the decentralized market, the buyers, you're going to need a medium of exchange to pay for things. And so more specifically, we're kind of building on Lagos and Rocheteau, where currency and claims on future output circulate as medium of exchange, borrowing some stuff from Steve Williamson and many others as well. Okay, so the setup in terms of agents, we've got 4 types of agents. We've got the usual buyers and sellers. And then we've got bankers and firms lumped together. So we're going to combine the financial and the productive sectors of the economy and just talk about one agent that operates both of those, which we'll call a banker or a banker firm. These bankers are going to borrow and invest in the centralized market in a technology that produces future output. And they're going to borrow by issuing deposits. And those deposits can be used by some buyers as a medium of exchange. That's what makes them a banker and not just a firm. And then the last agent is the central bank, which is going to issue currency. And there are going to be fiscal implications of these actions. And so I should emphasize when I say central bank, I really mean the consolidated public sector as a whole. Okay, so let me go through each of these in more detail. So let me start with the least standard part of the model, which are the bankers or the banker firms. So there are many of these agents we call bankers, and each of them has access to a productive project. And a project requires some input in the centralized market. Let's normalize the input required to 1, and it generates some output in the next period centralized market. That output is gamma J, and that's going to be heterogeneous across bankers. So there's no uncertainty here. So gamma J is known in advance, it's public information, but it's different. Some bankers are very productive and some are not so productive. And there's some distribution of gammas across bankers like in the graph here. Okay, so the key point really is just, this setup generates diminishing returns to aggregate investment. As there's more investment in the economy, the return generated by the marginal banker is going to be a less productive banker. And also, given the usual quasi-linearity of preferences, it's going to be obvious here which projects should be funded and which should not be funded in the first best allocation. The hurdle rate of return or the hurdle productivity should be 1 over beta, where beta is everyone's discount factor. So our bankers are going to live for 2 periods. So they're overlapping generations of them, and they have no endowment, so they need to borrow to operate their projects. So having the 2-period lives is just to avoid having bankers grow out of the need to borrow. And how do they borrow? Well, as I mentioned, they're going to issue deposits, and the deposit market's going to be competitive. So bankers, there's going to be a market interest rate, 1 plus R. The bankers are going to take that market interest rate as given. And then if a banker operates her project, her profit's going to be her output minus, remember, she had to borrow 1 unit. So her costs are just, she has to repay the loan, 1 plus D. We're also going to have a financial friction, which is a pledgeability constraint. So you can just look here, right? So a banker can only commit to repay a fraction theta of her output in the next period, which means that in order to be funded, the amount she needs to repay 1 plus RD on her deposits can be no more than gamma times her output tomorrow. And we'll talk about the case where gamma equals 1, so there's no friction, but the more interesting case I think is where gamma is less than 1. And in that case, that means that some projects that are profitable at the market interest rate are not going to be funded because of the friction. So this friction theta is going to be one of the key parameters for determining the optimal policy. So we're going to come back and talk about that a lot. All right. Now the buyers and the sellers, this is more straightforward. So in the decentralized market, the buyers want to consume, the sellers can produce, they're randomly matched. There's the usual information frictions, which means there's no credit in these meetings. The buyers have to bring a medium of exchange to the meeting, to the bilateral meeting. And we want to talk both about currency and bank deposits. So the way we're going to do that is we're going to have two types of sellers. So a type 1 seller can only accept currency in the decentralized market. And this is a technological restriction. So the type 1 seller cannot receive or cannot recognize bank deposits. And what we have in mind here is that these type 1 meetings are going to capture the transactions in reality where cash is attractive. So it may be because for anonymity reasons or low transactions costs, no need to connect to the bank payment network, things like that. And then there are going to be these other sellers, type 2 sellers, they can only accept bank deposits. So again, in the model, it's a technological restriction. But what we think of it as capturing, these are the transactions where cash is impractical in practice. So there are large values involved, internet transactions and things like that. We could add a third type of meeting where both types, both currency and bank deposits could be used. It doesn't add much, it complicates the notation. So we're just going to go with these two types.
Todd, CBDC is a currency or a bank deposit?
Yeah, good question. So this is the world without CBDC. That's going to be one of the design choices. So when you're designing the CBDC, we're going to let the central bank choose. Can it be used in only these meetings, only these, or can it be used in both?
Okay, thanks.
Okay, so now a buyer is in the centralized market. The buyer is going to learn the type of meeting they're going to be in advance, so you know whether you're going to be buying a cash good or a deposit good, and so you make your portfolio choice with that knowledge. Okay, last agent, the central bank. So the central bank is just going to be supplying currency, physical, and then later on digital currency. The central bank's going to implement an inflation target. So we're just going to fix the inflation rate at mu. So think of mu as 1.02. So there's just 2% inflation. We're going to take that as given. The central bank's going to, if it introduces digital currency, it gets to choose the nominal interest rate on the digital currency. Given that it's fixed the inflation rate, that's of course equivalent to choosing the real interest rate. And then these actions, as I mentioned, have fiscal consequences. We're going to have lump sum taxes and transfers in the background that are adjusting every period to balance the public sector's budget constraint. Okay, when we talk about optimal policy, welfare is going to be almost the sum of agents' utilities. So this is, I didn't introduce the notation, but this is the sum of everyone's consumption of the centralized market goods, the buyers, the sellers, and the bankers. Here you see the usual quasi-linear utility. This is the sum of the surpluses and the different types of decentralized meetings, and lambdas are the proportions of type 1 and type 2 sellers. The one thing that's not completely standard here that we borrow from Williamson is we allow for the possibility that the policymaker discounts the value of consumption in type 1 meetings. So this parameter nu could be 1, that would be normal, or it could be less than 1, that would be discounting these meetings. And the idea here is just that, you know, these transactions that take place using cash, it might be the case the policymaker thinks some of those are undesirable. They represent criminal activity, for example. And I think it seems important to at least allow for this possibility when we're talking about introducing a new form of currency that potentially could be used in those meetings. Okay, so looking ahead, this parameter nu is going to be another key parameter for figuring out what the optimal policy looks like. Okay, so let's talk about the current world. Forget about CBDC for just a couple of minutes and talk about what an equilibrium in this model is a fairly standard thing. I just want to give you some pictures to highlight the key features that are going to change when we introduce the digital currency. Okay, so think about the decentralized market. First, think about the cash meetings. This is completely standard, right? But let me just go through it. So if you're a buyer and you know you're going to enter, you're potentially going to meet a cash seller in the decentralized market, you choose your real cash balance as M, thinking about the real rate of return on holding money, which is the inverse of the inflation rate. We make assumptions on preferences, so that's an increasing relationship. It's vertical at 1/beta because of the quasi-linear preferences. And then monetary policy determines the inflation rate. So it just determines the real return on money. That determines the real balances, cash balances that buyers hold. And those real balances then determine how much trade there is in the decentralized meetings. When the inflation rate is higher, buyers economize more on cash and a lower fraction of the potential gains from trade are realized in cash meetings. That's all completely standard. The only thing to sort of pay attention to here is remember when we're measuring welfare from these meetings, we may be discounting. So if we ask the policymaker, what's the efficient level of trade from the policymaker's point of view in these meetings, it might not be where U prime equals W prime. If nu is smaller than 1, it'll be smaller, right? And so that's the effect of this new parameter. All right, what about a buyer entering a deposit meeting? It's kind of the same thing, but you're choosing the real value of the deposits you want to hold in a bank as a function of the market interest rate on deposits. But now the interesting part of the model is, well, what is the supply of deposits? So if we knew the supply of deposits, if it were some curve that looked like this, well, then you'd say, okay, that determines the equilibrium interest rate on deposits and the quantity buyers hold. Quantity of deposits determines the quantity of trade. That goes into welfare in the usual way. So the key question is, what determines the supply of deposits in this model? And the key idea in the model is that in order to supply deposits, bankers need to operate their projects so that they're creating this pledgeable income in the next period that they're going to use to repay the deposits. So that means the supply of deposits depends on the distribution of bankers' productivities, which we call G here. So let me just sort of trace out a supply curve in this graph by referencing the distribution of productivities. So, I think about it this way. Suppose the market interest rate on deposits is really low. Suppose the gross interest rate is 0. Bankers don't have to repay anything. Well, then all of the bankers can repay, nothing. So the supply of deposits would be the total measure of projects to which we've normalized to 1. And then as you think about increasing the interest rate, as the interest rate on deposits increases, the least productive bankers are no longer viable. They don't have enough pledgeable income to repay that. So they don't get funded. So the measure of projects that can be funded at that interest rate decreases, and that just continues. All right, and so it's the distribution of banker productivities combined with this pledgeability parameter theta determined at any given interest rate, what's the quantity of deposits the banking system is capable of creating, right? And so that's going to be some downward sloping relationship, and that's our supply of deposits in the model. Right, so what is an equilibrium? You can think of everything in this model sort of coming out of supply equals demand in the deposit market. So the interesting case for us is where the supply curve and the demand curve cross on the upward sloping of the demand curve. So the crossing, the supply curve could be up here and the crossing could be here. In that case, where there's sort of a high supply of deposits, there's no role for a digital currency in the model, and there's no concern with disintermediation. All right, so what we want to do is focus on the case where high return projects are scarce, meaning sort of the number of high productivity projects is low enough that the supply curve crosses the demand curve on the upward sloping part, which means the equilibrium interest rate on deposits is less than 1/beta, so that's a liquidity premium. And that gives us a sense in the model in which deposits are low cost funding, which remember, from the policy quotes in the introduction, this is the way at least some policymakers think about deposits. Now, there's a negative side to having a low interest rate on deposits, which is that the usual monetarist concern. So buyers economize, they hold relatively few real deposits, which means that when they meet a seller, the fraction of the potential gains from trades that's realized is small. Okay, so having a liquidity premium means inefficient exchange. But there's also a positive side in our model, which comes from the investment cutoff. So remember, because of the pledgeability constraint, it may be the case that there are some productive projects out there that aren't funded, because even though they're productive, the banker doesn't have enough pledgeable future income to be able to borrow. Well, the liquidity premium decreases the interest rate on deposits, which shifts this cutoff to the left, right? By lowering the interest rate on deposits, this allows some of those bankers to be funded. So so in other words, banks' access to low-cost funding helps offset the financial friction in our model. All right, let me skip that. So if that's the world, now let's talk about introducing a digital currency. What changes? So first, well, what for us is a central bank digital currency? So it's outside money, so it's issued by the central bank, not by the private banking system. The central bank is going to be willing to exchange in every centralized market. The central bank is going to be willing to exchange physical and digital currency 1 for 1. So that means the price level is going to be the same. These are the same currency. They're in the same units. But different from physical currency, it can earn interest at a positive or negative at a rate set by the central bank. And then this is my answer to Marcus's earlier questions. So now the central bank, we're going to allow to choose the design. And by design, we mean the central bank could choose features that make the currency cash-like. As I mentioned before, restrict the size of holdings and the methods of transfer so that's a good substitute for physical currency, but a poor substitute for bank deposits. If you can do that, we'll say that's a cash-like design. Alternatively, you could set it up in a way that it looks a lot like bank deposits. It comes with a debit card with a number. You can use it online. It operates over the existing payment network. So it might be a good substitute for bank deposits, but not such a great substitute for currency. So we'd call that a deposit-like design. Or perhaps it can be designed in such a way that it's actually perfectly good in both situations. And we'll call that a universal design. Okay. So again, so behind this are some assumptions that technologically it's feasible to make this thing work like cash, work like deposits, or work like both. And we're going to just trace out the implications of those 3 choices. So question, should the central bank introduce a digital currency? If so, which of the 3 designs should it use, and how should it set the interest rate? Okay, first, in the model, think about a buyer who is making a portfolio choice in the centralized market. How does the digital currency affect their demand for the existing assets? Well, if I'm a cash buyer, and if the currency has these cash-like features, well, what it's going to do is it's just going to put a lower bound on the interest rate on my demand for cash, right? Which is just to say, if the digital currency offers a better return than physical currency, I'm only going to hold the digital currency. If it offers a worse return, I'm only going to hold the physical currency. Okay, and the same thing is true if the digital currency is a substitute for bank deposits, then the same thing is true for deposit buyers, right? They're just going to look at whichever offers the higher return. That's what they want to hold. Okay, and if it's a universal design, well, then it changes the demand of both types of buyers. So what's the effect, the equilibrium effect in cash meetings then? Well, if the central bank introduces the digital currency, and if it has a higher real return than physical currency, so if the nominal interest rate is positive, well, then all of the cash buyers are going to switch. So physical currency is going to disappear. Everyone switches to CBDC. Because it offers a higher return, they're going to hold higher real balances. Because they're holding higher real balances in these type 1 meetings, we're going to get more trade. Is that good? Well, it depends on, remember this parameter nu, how the policymaker feels about the value of these trades in type 1 meetings. So if we set nu to 1, meaning the policymaker fully counts the utility that these cash buyers get, well, then the increase in DM trade necessarily raises welfare. So when nu is high, we're going to think of that's a policymaker who's concerned about financial inclusion, right? They want to provide a better medium of exchange to people who are currently outside the banking system using cash. Okay, but a policymaker is more concerned about not promoting criminal activity. This increase, all I want to say is this increase in real balances and the increase in trade may actually lower welfare. Okay, deposit meetings are more interesting. So here now, suppose the digital currency can be used as a substitute for bank deposits. Suppose the central bank sets the real interest rate higher than the current equilibrium interest rate on deposits in our world without a digital currency. Then what happens? Well, if anyone's going to hold deposits, the interest rate on deposits has to rise. It has to rise up to the interest rate, the real interest rate being paid on the digital currency. That means the quantity of deposits is going to fall and the investment cutoff is going to increase. So this is the disintermediation. The banking sector is going to shrink because the cost of funding has gone up and some projects that were previously viable are no longer viable. So that's kind of the negative side. The positive side, though, is that total liquid real balances, bank deposits plus CBDC held by these buyers goes up, right? And that means that's going to lead to more efficient exchange in their decentralized meetings, which is going to be good. So in other words, here there's sort of a trade-off the central bank's facing. Offering the digital currency that competes with deposits and offering an attractive interest rate does crowd out investment funded by banks, but it also promotes more efficient exchange.
Todd, you have 4 minutes left.
Yep. Sure. So I'll spend those 4 minutes on the optimal policy. So what should a central bank do? So if the central bank's going to introduce a digital currency that competes with physical currency, how should it set the interest rate? Well, it's going to depend primarily on that parameter nu. Sort of how does it feel about these type 1 transactions? Are they socially valuable or not? For a given nu, you can calculate the optimal balance. If you introduce a digital currency that competes with bank deposits, you have a different trade-off, right? The higher interest rate, which I just described, means more disintermediation and less investment, which seems bad, but also more decentralized market trade. You're closer to the optimum quantity of money, which is good. Overall, the optimal policy is going to be to choose the design and the interest rate to manage these two trade-offs. So let me just try and summarize that along a couple of dimensions. First, thinking about the key parameters, introducing a CBDC is going to be more valuable when the current liquidity premium is large. So if the supply of productive projects, the quantity of productive projects is relatively small, and that means that the current supply of money provided by the banking system is far from the optimum, then introducing a CBDC is going to be more attractive. It's also going to be more attractive when investment frictions are small. So when this pledgeability parameter is high, close to 1, because when the investment frictions are small, you want a small liquidity premium, and introducing a digital currency and paying a high interest rate on it is a way to drive down the liquidity premium. And it's also going to be more valuable when exchange using cash, the policymaker considers that to be socially useful when this new parameter is high. So here's a graph that kind of summarizes some of that. So behind this graph, I'm saying, suppose that whatever design it chooses, the central bank sets the interest rate optimally. So sort of this optimization problem going on in the background. Then the best design as a function of the financial friction and as a function of the new parameter, the welfare weight of the cash transactions has these features. If financial frictions are strong, and if there's a lot of this type 1 activity is not socially valuable, that's when a CBDC is not going to be desirable. Okay, but as you decrease the financial frictions, right, then the disintermediation concern gets smaller. You want the liquidity premium to be smaller, and having a central bank digital currency that competes with deposits becomes more attractive. As you increase the value the policymaker puts on cash transactions, so the policymaker is more concerned about financial inclusion, cash-like digital currency becomes more attractive. And as you do both of these things, this is where a universal digital currency that can be used in all types of meetings becomes optimal. All right, so just quickly concluding, should central banks issue digital currency? So, the goal of the paper is to provide a framework for answering the question. And we think we have a framework that captures at least some of the key concerns policymakers have expressed. Note, in some ways, our framework is biased against a CBDC. So we've sort of built the model in such a way that the disintermediation concern is strong. But despite that fact, we see the answer is often yes. A digital currency does raise welfare. And the key insight is that the interest rate on the digital currency is a new policy tool, and the central bank can use that to manage whatever trade-offs arise. I'll just end with a note of caution. Another way to read our results is says, a central bank digital currency is good as long as the central bank chooses the design and the interest rate appropriately. And in particular, the optimal nominal interest rate on digital currency could be positive or it could be negative, which sort of echoes some of the comments in the first presentation. So arbitrary choices of introducing a digital currency and fixing the interest rate could easily decrease welfare, right? What we want to say is sort of under the appropriate design, the answer is often going to be yes, central banks should introduce digital currency.
Thanks a lot, Todd. So if any questions from the audience, please raise your hand. But first we go to the panel members, and perhaps I can interject a question too. So one is from the audience, and I will throw it in right away, from Min Kim. He would like to know how important is the constant inflation assumption, or is it just you don't want to have any inflation surprises?
Yeah. So I should have said, we focus on stationary equilibrium, and a stationary equilibrium inflation is going to be constant over time anyway. So in a sense, I'd say it's not important. The one thing, the thing that is perhaps worth discussing is that the inflation rate is fixed, right? It's not being chosen optimally. So if I can go back, you could say, okay, suppose the policymaker is choosing the inflation rate optimally in our model for a given policy parameter nu, right? And if you were doing that, that would mean cash is already fine-tuned. It's exactly offering the right rate of return for cash transactions. And that would take away any need for a cash-like digital currency. So we're kind of assuming that the policymaker has two goals. They want 2% inflation, but they also may want people who are transacting with cash to have a better rate of return than that. And that's what generates the potential benefits from a cash-like digital currency.
So let me throw in one question on my own, which is like you made a big hidden assumption here that the central bank cannot lend to the private banks up-to-date rate, and for the neutrality result.
Only because of the time constraints, and these graphs at the end were new and we're excited, and I wanted to fit those in. So if we had 32 minutes instead of 30, I would have had these slides on the neutrality result. Which cite your work with Dirk, but yes, and if you give me like 60 seconds now, I'll explain this because I think it's interesting, right? So take our model and ask, could you introduce a central bank digital currency? Let's focus on a deposit-like digital currency in a way that doesn't affect anything, right? So we're trying to get your neutrality result, and the answer is yes, right? And how would you do it? First step. Calculate the equilibrium interest rate with no digital currency on deposits. Set the real return on the digital currency equal to that interest rate. All right. And so now the digital currency exists, but no one holds it. But everyone's exactly indifferent between holding it or not. And then have the central bank lend to the banks. All right. And what essentially now the central bank becomes a depositor. In terms of the model, that shifts the deposit curve up by the amount the central bank lends. And you see what happens, what's got to happen in our model is that the buyers, whatever amount the central bank lends to banks, buyers end up holding that amount of the digital currency, right? So we can get your result. You can introduce the CBDC, some buyers are holding it. You haven't disintermediated banks, but then what we'd say is our point is, but you've also got this new policy tool. You can pay interest on it, and that allows you to affect the liquidity premium and real allocations in a way you couldn't before. And for the parameter values where we say, yes, the central bank should issue digital currency, they're actually raising welfare. They could do this, but they're raising welfare by setting it differently. Thanks.
So Linda has raised her hand.
Yes.
Any participant who wants to raise hands, please do now. It's your chance. Linda, your floor is yours.
Yeah, Todd, maybe I missed it, but can you a little bit talk about, so how does the central bank pay the interest rate on CBDC? Is this productive in some way, or is this financed through printing money, or how does it look like?
Yeah, well, this is through taxes. So there's the budget constraint of the public sector is balanced every period with lump sum taxes and transfers. And the digital currency definitely affects that. So when you introduce it, the period you introduce it, there's a big inflow in to the public sector, and they transfer that out. And then to pay the interest over time, they collect taxes back to pay it. Now you could think of them doing something else, but what we don't want to do, I mean, okay, maybe I'll just end there, right?
Are there any further questions? Otherwise, I throw another one in. Harold?
Yeah, I mean, like us, right? You have this exogenous price stability goal, right, which gives rise to all the complication. Otherwise, you could just adjust inflation, be done with this. I mean, something that we didn't do and you also didn't do, I guess, is having a reason why inflation should be, maybe zero in the first place due to sticky prices or some distortion of that sort. I mean, have you thought about, the trade-offs here between paying nominal interest rates on CBDC versus the inflation goal? I mean, it seems to be very intertwined, right?
Yeah, that's right. So yeah, we've thought about it a bit. I don't have any deep insights there, but let me just say one thing. It's kind of like we have these two dimensions here, right? Is it competing with cash and is it competing with deposits? And this is all about the cash side, which in a sense I think is interesting, but I think the deposit side is actually more interesting. So that's why we didn't want to go into great detail about trying to justify the inflation goal. I want more of the focus to be on it competing with deposits, which is a bit in the end orthogonal to the inflation rate issue.
Harold, let me add one more thing. So if you can adjust the nominal interest, but remember you have this financial friction, the deposit set. So you don't achieve the first best allocation, even if you can manipulate the money, the inflation rate and the interest rate on CBDC. So remember you have this other financial friction going on. So
But I thought Todd answered the previous question that arose that if they could choose the inflation rate optimally, then there would be no reason for having a CBDC here, or is there? I mean, that would be the interesting question.
Yeah, this is important. There'd be no reason to have CBDC used in the cash meetings, in the type 1 meetings.
Yeah, that's
sort of like it would
answer.
take out this dimension, but we'd still have this dimension, and this dimension would be largely unchanged. Then you just say, okay, now do we want a CBDC that competes with deposits? Well, we've got to think about the disintermediation issue. In fact, what it would be exactly on this diagram, it would be well, no. Well, why do you say that?
Well, why would you want to disintermediate then if the cash issue is solved? So maybe go into.
Yeah. So we're talking about sort of focusing on this slice of this graph where you're sort of exactly indifferent between introducing the cash-like or digital currency or not, because the inflation rate is exactly where you want it, but you'd still have this decision. Do you want the digital currency competing with deposits? And over here, the answer is yes. And the answer is yes, because the deposit, when the interest rate on deposit's low, you've got a big liquidity premium. And if you're a bank depositor, that's bad news for you, right? And these guys are holding low balances. You're not getting much trade in the DM meetings where the deposit holders are there. So you want to offer them and so there you have this trade-off. The deposit like digital currency is going to disintermediate banks, bad. That's going to decrease investment a bit, bad. But you're getting this increase in the real balances held by the deposit buyers, and you're getting this increase in trade in DM meetings where deposits plus CBDC are used, and that's good.
And I guess it comes about because the government here has a way to pay higher real interest rates than banks effectively via taxation. Is that the way to think about it? Because the resources have to come from somewhere, which is sort of Linda's question. I mean, I'm sort of
in equilibrium. They're paying the same interest rate, just to be clear. But yeah, the government's raising the real interest rate. Remember, and they're not in a dynamic sense, they're not losing money, right? When they issue the digital currency, goods flow in, and then over time they pay goods out in interest. Now we just have the central bank doing it period by period with lump sum taxes. But I just want to point out, it's not that you're in terms of the budget constraint, you have positive net expenditures on the digital currency. but you are using you are increasing the supply of money in the economy, right? So when you have a liquidity premium, there's a shortage of sort of real assets that can be used to back money, and that's creating problems. And the central bank is relieving that by using its ability to tax in the future to generate future revenues that can back the digital currency.
So Todd, can I interject another question by an anonymous attendee? You can answer very quickly. Is the anonymity assumed as a feature of CBDC in your model? Does it matter in your model whether it's anonymous or not, like cash?
So, I mean, yes and no. So I want to say, no. I'm not sure about the question, but the anonymity of buyers and sellers, so that you need a medium of exchange, that stuff is important. So that there's no credit in the decentralized market. But does cash, is the anonymity of the CBDC, we think of that again as being a bit of a design choice. If when we say the CBDC is being designed so it can be used in type 1 transactions, then you could think of, well, maybe that involves I can use it somewhat anonymously. Whereas if we're saying it's being designed in a way that it cannot be used in type 1 transactions, maybe the reason it can't is because those people demand more anonymity and the CBDC is not delivering that. The government can track your transactions, for example.
Okay. I have one more question, but I will ask you afterwards because
Okay.
we're running on time. So I want to stay on time. So thanks a lot, Todd and Daniel. That's a great presentation. And we move on to the next paper presented by Jonathan Payne, my colleague at Princeton. Jonathan, the floor is yours. I can see your slides.
Can everyone see my slides?
Yes.
Okay, well, thank you very much for coming and listening. And I guess thank you to Marcus for putting our paper on the program and organizing the session. This is a paper with Marcus on platforms and tokens. Okay, so there's been a lot of recent interest from digital platforms about sort of getting involved in the provision of money and payment services. So to take a couple of examples, you could think about in China, you can think about Alibaba and WeChat essentially dominating the digital payment environment. In terms of the US, you can think about Facebook's attempts to get Libra going and DM as it's now called. So there's been a lot of recent interest from these digital platforms in these money-like services. The question, though, that Marcus and I think is unclear is how we'd want to regulate the provision of these private digital currencies. And this question of regulation is very much one about interoperability. So we could ask, how do we want to regulate fees for exchanging tokens back into the dollar currency in the economy? So that'd be the interoperability between sort of digital currencies and dollars. We could also think about the regulation of fees for exchanging tokens between different platforms, the interoperability between platforms. So what we do in this paper is we attempt to go after these questions. So we put together a new model to try to understand how platforms design and manage private digital currencies. And in this model, our focus is very much on the interaction between the market design problem. So that is, how does the platform try to make their market an attractive place to transact? And the currency design problem. That is, how does the platform make it attractive for people to hold their currency? And then once we understand this platform design problem, we then think about the impact of a number of policies. Today, I'll talk about the impact of monetary policy and the impact of having sort of interoperability regulation on these design problems. Okay. So to give you a bit of a flavor of what this model is going to look like, it has a number of sort of key ingredients. So we're going to think about an environment that has buyers and sellers who are waiting for random trading opportunities. And when they get one of these trading opportunities, the buyers and sellers can go to one of two platforms. So they can go to a private platform, which requires payment in its own currency. It's going to be the private digital token in this world. Or they can go to a public platform, which requires payment in the central bank currency, which we'll think about as money in this model. And the difficulty for these buyers and sellers is that this currency market is going to be frictional in the sense that while they're waiting for the trading opportunity, the buyers are able to exchange currencies in a competitive market. But when they get this trading opportunity and they're trying to purchase goods, buyers can only exchange currencies with the private platform. So this gives the private platform some power in this world to penalize the use of money on their platform. So given these platforms, given this frictional currency market, the platform has to solve this market and currency design problem. So this involves choosing how to set markups and subsidies for purchases on their platform. It involves deciding what fees they want to charge for converting money into tokens or tokens into money when someone arrives at their platform. So we'll call those the into token fees and the outer token fees. And they also have to think about how to change the token supply growth rate. Okay, so that's roughly what the model is going to look like. What are the main things we get out of it? Well, first of all, we can, is that a question? No. First of all, we can
had an ermine-lined crimson velvet mantle with a golden bee motif, bordered with olive, laurel, and oak leaves, which weighed more than 80 pounds. So it took Joseph.
I hear something. Okay. I'll go on, I think.
Just keep going.
Yeah, okay. So we can first of all understand the trade-offs the platform faces in trying to balance the monetizing through market design and monetizing through currency design. So we could think about the platform wanting to increase markups. So if they increase markups, that's going to make the platform less attractive, fewer people come. And so fewer people need to hold the tokens to be able to use on the platform. So token portfolio share and signage revenue goes down. Likewise, if they want to try to increase the token growth rate, we see that this makes the token less attractive because we get token inflation. So fewer people hold the token, and that ultimately ends up making the platform less attractive as well because people don't hold the right currency to go to the private platform. And finally, we can think about what these exchange rate fees are doing. And if we have high inter-token fees, so high fees for exchanging dollars for tokens when you arrive at the platform, then that ends up making the tokens more attractive because the need to get them in advance is higher, but ultimately makes the platform less attractive. So the platform has this trade-off. Okay, so we're able to explore what these mechanisms look like in the design problem. And then we think about these two policy questions I raised at the start. So first of all, we can see that what happens when you increase the growth rate of central bank currency is this ends up driving down private platform markups. And secondly, we can think about a sort of perfect digital interoperability between currencies. So we could think of this as introducing a CBDC that is legal tender. And what this ends up implying is that the private platforms would choose to create stablecoins, so the tokens that have a fixed exchange rate to money. And in terms of their revenue generation model, these private platforms would move from having a sort of low markup, high volume strategy to having a high markup, low volume strategy. So it really changes the way the private platform wants to organize getting revenue. Okay. So there's a lot of literature related to this. I won't spend a lot of time on it. If I've left someone's paper off, I apologize. It's certainly not intentional. I think the closest papers to our work are the paper by Chu and Wong, which also thinks about this issue of a platform design problem. And I guess there's also these papers by Lagos and Zhang that think about government currency as an outside option that ends up changing markups. And so I think the government currency plays a similar kind of role in this model. Okay. So with that in mind, let's get into the model. So it's going to be a continuous time, infinite horizon environment. And there are going to be different kinds of goods. So there are input goods, and there's one final consumption good. Then there are a continuum of buyers and sellers arriving in the economy with different endowments. So there are buyers that arrive randomly with wealth, and they get and they live, and then they get production opportunities. And when they get the production opportunity, they then exit the economy. The sellers, they arrive randomly with input goods, and they exit and trade immediately. So the buyers are long-lived and the sellers are very short-lived. And both the buyers and sellers have the same utility function. They all get log utility from consuming the final consumption good at the point when they exit the economy. Okay. So what do these production opportunities do then? Well, when one of these production opportunities arrives, is buyers can transform their input goods into final goods at some rate Z, so long as they find the right input goods for them to be able to use with their production technology. Okay, so that's the setting with the preferences and production. Tried to make it as simple as possible. what do these markets end up looking like? Well, there's a final goods market, but for this talk, we're just going to leave that as exogenous, and we're going to think of that as having the numeraire price. The action in this model comes in the market for input goods, and these input goods that these sellers turn up with and the buyers want to purchase. These input goods are traded on two different platforms. And I use P to denote the platform, and they're traded using platform-specific currencies, which I denote by the C. So I'll call P is equal to 0. That's going to be the public platform. And the public platform is completely competitive. So all the input goods trade in symmetric prices, P0. Okay. The private platform, however, is not competitive in the sense that the platform owner runs it to try and maximize profits. And so they're able to charge a markup, which I denote by this psi, on trade on their private platform. Likewise, we have the two currencies. So C is equal to 0 is the government provided currency, and C is equal to 1 are the platform tokens. And then I use mu for the growth rates of the two different currencies. Okay, so they're the goods markets. What about the currency markets? Well, while waiting for a production opportunity, the buyers are able to trade currencies frictionlessly in a competitive market. I use QC to denote the price of currency C, and it follows a drift process over time since there's no aggregate shock in this economy. Okay, so while waiting for production opportunities, the currency market is completely frictionless. The difficulty for the buyers is what happens when a production opportunity arises. So when they get one of these production opportunities, the buyers can only trade currencies with the private platform. This gives the private platform some market power, and they're able to impose an exchange rate fee. So I use epsilons for these exchange rate fees. So epsilon 0.1 is the proportional fee for swapping money into private tokens. That's currency 0 to currency 1. And epsilon 1.0 is the proportional fee for swapping private tokens into money, going from currency 1 to currency 0. I've put these 4 variables in color, the red, the blue, and the green, because these are the 4 choices in these markets that the platform is going to be able to make in the end. Right? This is what they're going to influence in their platform design problem. Okay. So the final part of the environment we need to think about is the timing when these buyers and sellers go to a platform and try to match and trade. Okay. So we'll talk it through, first of all, from the buyer's point of view over here on the left. So when a buyer gets one of these production opportunities, during that production instant, they enter with a certain currency portfolio they've already chosen. They then get an idiosyncratic amenity shock for each of the 2 platforms. So you can interpret this as a platform, person, and time-specific shock for how easy it is to search for a particular good at a particular point in time. Okay. And this idiosyncratic amenity shock is going to follow a Gumbel distribution. So we're able to use all the extreme value theory, like in the trade literature or discrete choice literature, to make everything clean. Okay, so the agents get these idiosyncratic amenity shocks. Then after they see this idiosyncratic amenity shock, they choose which platform they want to buy on. And then they go to the platform, and then they have to find the correct good. And they find the correct good with probability var P, where in principle, this probability of finding the correct good can depend on the fraction of buyers and sellers that go to the platform. So we can think about some kind of diseconomies or economies of scale in the matching if we want, although for the most part of this talk, we're just going to think about this being equal to 1. We can come back to this at the end. Okay, so after they've got their amenity shock, they've chosen the platform to buy on, they've potentially found their good, they then choose whether they want to exchange currency, they choose their input purchases, they produce, they consume, and die. Okay, so it's the timing for the buyers inside a period. The timing for the sellers looks very similar, except they don't have this issue of the currency. They enter with input goods, they get the idiosyncratic amenity shock on their side, and then they choose where to sell, and then they consume and ultimately die as well. Okay, so that's the summary of this environment with the markets and the timing once these agents go to these platforms. We want to head towards the platform problem. Before we do that, we need to think a little bit about what are the optimal buyer and seller choices given this environment. So the first buyer choice to think about is the the choice before they even reach the platform. So how do they want to set up their currency portfolio? Okay. So while the buyer is waiting for their production opportunity, their state variable is their financial wealth. Okay, they're the market value of the different monies they hold, or different currencies they hold. And what they have to do is they have to choose the fraction of their portfolio they want to allocate into digital tokens. I denote that by theta, and the fraction in money, which is 1 minus theta. And ultimately, when we solve this problem, we end up with a portfolio allocation decision that looks very similar to the standard literature, in the sense that we see that what the platform does is they choose their portfolio so that the excess return on platform holdings, that is the drift in the price of tokens minus the drift in the price of money, is equal to the marginal benefit of having more platform tokens when they buy goods. I'm not going to specify everything about this benefit function, but what's important to understand here is it's the expected benefit where we take this expectation with respect to the platform amenity shock that they don't know about. Okay, so stepping back from this optimal portfolio choice, what do we end up learning about how the platform's decisions end up affecting the portfolio decision of the buyers? Well, first of all, we can think about what happens when the markup goes up. So if the platform chooses to increase the markup on their platform, this ends up decreasing the portfolio holdings in the digital currency. Because in this case, there's less need for the buyers to go to the platform, and so they hold less currency to use in advance. Likewise, if the platform chooses to increase the inter-token fee, so that is, if you turn up at the platform and you have money and you want to try to exchange the money and purchase on the platform, if the fee is very high, that gives the buyers a greater precautionary motive to hold money, and so their portfolio share in money goes up. Okay, so that's what the buyer choice ends up looking like. What's the other part of the agent problems we need to think about? Well, the other part we have to think about are the fraction of agents that go to each of these two different platforms. So here we have first the fraction of sellers that choose a particular platform P. And we can see that what ends up happening is the fraction of sellers that go to a platform is really just dependent on the price, right? So it's the price on that platform divided by the average price across the different platforms. And so if there's an increase in the price on a particular platform, more sellers want to go there. Likewise, we can think about what happens for the fraction of buyers going to a particular platform. And here the formula looks similar, except it's complicated a bit by the currency exchange and production decisions. So here we get that the fraction of buyers that want to go to a particular platform is the profit they get from trading on that platform divided by the average profit they get across the two different platforms. That's what this top is divided by the bottom, where this pi c is the profit from purchasing input goods on platform P using a particular currency. Okay, so we can see here that what are the comparative statics? Well, if there's an increase in the price on the platform, an increase in the markup, an increase in the exchange rates, or a decrease in the portfolio holdings of the buyer coming in, all of these decrease the fraction of buyers that end up going to a particular platform. Okay. So that summarizes the key agent decisions. What about the platform problem? Well, the platform, and here we're going to think about a platform at least, first of all, with full commitment. So the platform with full commitment, they choose these variables, the markup, the money growth, the exchange rate fees. They choose this to select the market equilibrium that maximizes their profit. And since we restrict attention to stationary equilibria here, we can think about them wanting to maximize their per period profit. And what makes up their per period profit? Well, the first part is their markup and inter-token fee revenue, right? So this X here, is the volume of goods bought by buyers on the platform, and this XS is the volume of goods sold on the platform. And here we get the markup and inter-token fee revenue they get from the sales of goods on the platform. They also get fees if people choose to sell their currency. They take their currency away from the platforms. This is the out of token fee. And they also get signage revenue, but the signage revenue here ends up being the growth rate of their money times the fraction of currency held in platform tokens. Okay, so that's what the platform that's what the platform problem ends up looking like. And so we can see again these dynamics we can see again the trade-offs that the platform faces. So if they choose to increase the markup on the platform, that means that fewer buyers want to go to the platform. And so the volume of trade on the platform, this XB1C, goes down. Fewer people hold the portfolio and they get less signage revenue. Likewise, if they increase token growth, we get token inflation and fewer people hold the currency. So fewer people end up going to the platform and decreases markup revenue. Okay, so we see these trade-offs coming out that I talked about in the introduction. All right. We can see this, in a numerical illustration. So here we have the way the equilibrium is changing as the platform changes their markup. To take one example, so we see the markup goes up, people hold less of the currency, and we can see the impact on the fraction of buyers and sellers, and ultimately the price on the two different platforms. Okay, and we can see the curvature in the platform profit and where they want to be. Okay, we could do a similar thing for mu1, but I'm going to leave that in the interest of time and go on to think about two policy experiments in this environment. So first of all, I'm going to think about increasing the growth rate of central bank money, and then I'm going to think about imposing perfect interoperability, the sort of CBDC legal tender. So first of all, increasing this growth rate of money. So to keep things simple, I'm going to focus on a special case where we think about no currency exchange at the platforms at all. So this is a non-interoperability case where the exchange rate fees are so high that you only use dollars on the public platform and you only use tokens on the private platform. And we'll restrict attention to stable coins to get a clean formula so you can see what's going on. So in this case, the platform is choosing their markup to balance markup revenue and signage revenue. And we can see that as the growth rate of government money goes up, that increases the marginal benefit of having more people hold your currency, right? Increases the marginal benefit of getting a higher theta. And so that means that the platform has an incentive to decrease markups, to try to make the platform more attractive and ultimately get more people using their currency. Okay, so we can see that playing out. I guess, Marcus, you haven't given me a time warning. How much time do I have left? You're muted, Marcus.
9 minutes.
Oh, 9 minutes.
Can I make a mistake? Oh, sorry, 5:30. It's 4 minutes.
I think, yeah, okay. All right. So what we can see here is we see the impact of an increase in the government money supply. We can see the markup, the platform charges coming down. We can see the increase in the fraction of people that go to the platform and the change in the prices on the two different platforms. And this is coming from the desire to increase.
Jordan, you're till 5:35, so it was 9 minutes.
Well, it's 9 minutes. Okay, I think I've got the timing. Okay. Okay. So then we can think about the other example. Okay, so we can think about the interoperability question. So in this case, we can think about interoperability here as having no exchange rate fee. Okay, so if we have the epsilon 0,1 and the epsilon 1,0 to B0, this is what we'll think about as perfect interoperability. So how would we interpret this? Well, if we think about the epsilon 0,1 as being 0, we interpret this as there being a central bank digital currency that is legal tender across all the platforms. So you're not allowed to charge some kind of an entry fee for coming with central bank digital currency as opposed to the platform token. And then we also think about the exit fee being 0, right? This epsilon 0,1 being 0, which is really a regulation against the private currency creator charging some kind of fee for trying to exit the currency and go back into dollars. Okay, so this is what we think of as perfect interoperability in this environment. So what does this end up doing to the platform's optimal decision? Okay, well, in this case, what the platform is going to want to do is the platform is going to want to choose the money supply so that they get a stable coin arrangement, right? So that the price of the private digital token is the same as the price of the government money. Why is this? Well, in this case, buyers are really indifferent about which kind of currency they're going to pay with. And so they just want to hold the currency that has the higher return. Because there's no interoperability fees. So in this case, the platform can always attract all the buyers by simply setting the growth rate in their money supply to be slightly less than the growth rate in the government's money supply. So in this sense, there's no reason for them to have any significantly higher growth rate or significantly higher growth rate in the money supply or in the price compared to what the government is doing. And so the equilibrium that emerges here is an equilibrium where the government, where the platform chooses the same growth rate as the money supply, and we get a stable coin. And the buyers choose to hold all of their currency in the digital token. All right. Okay. So how does it end up changing the behavior of the way the platform tries to maximize revenue? So here I've plotted these where again, I've got the growth rate of government money supply on the x-axis, and then I've got the various objects in the economy on the other axis. So the first thing we can see is that once we have this interoperability, the economy loses its dependence on the government. Well, the design problem of the platform loses its dependence on the growth rate of the government money supply. This is the move from the blue line to this red line here. Or I should have said the red line depicts the world with full interoperability, and the blue line depicts the world with no interoperability, the same world that we had in the first example a moment ago. Okay. So how does that end up feeding through into the rest of these variables? Well, we see that the fraction of trade on the platform ends up going down, right? So if we compare the fraction of buyers that go to the platform on the blue line and the fraction of buyers that go to the platform on the red line, and similar with sellers, we see a drop in the volume of trade. And what we see is an increase in var theta, an increase in the currency holdings of the platform. And we see in this sense that the platform is reorienting its revenue maximization strategy away from one that's trying to get a lot of volume of trade to one that's trying to get a lot of currency holding. Okay, we can also see what happens to the prices. And here I've plotted the value for the buyers and the value for the sellers. And we can see that moving to this world with full interoperability ends up hurting the buyers, but benefiting the sellers in this environment. Okay. So I think that brings me to a close, I guess a couple of minutes early. So what we did here is we put together a new model for market and currency design by digital platforms. And we see there's a sort of trade-off that emerges between trying to extract signage revenue and trying to extract market revenue. And then we thought about how policies affect this design trade-off. And we saw that the central bank money growth ends up lowering the markets. And we see that trying to impose digital interoperability ends up causing the digital platform to reorient from a sort of low markup, high volume strategy to a high markup, low volume strategy. Okay. And I guess briefly to mention sort of other things we end up doing. I mean, we haven't spoken a lot here about the externality or the issue of imperfect matching, where more people going to the platform increases the matching rate. So we go on and think about this possibility of multiple equilibria or steady states. But I'll leave it here for this talk. Thank you.
Thanks a lot, Jonathan. Are there any reactions, questions among the panelists?
Yeah, so Jonathan, I was trying to think about efficient allocations and welfare. Is it easy to see what efficient allocations look like here? Do you want everyone on one platform in particular?
No, you don't want everybody on one platform. So the way this world works is there are idiosyncratic shocks where, in essence, people are, at any point in time, people have different preferences about which platform they'd like to go to. So you always want some trade on both platforms. This is ultimately what gives the private platform its market power. There are always some people that really want to go to that platform. So there isn't a dominant platform in that sense. Yeah.
So I've actually have two questions. So one is, in essence, there is this, proprietary platform, right? That tries to, one way of thinking is they're taxing transactions in sort of, with a multitude of tax instruments, really, right? So how much can one just think of this as an environment where this, second platform, I guess it's platform one, it's not about tokens, it's just about taxing transactions, and it chooses its optimal tax rates. So the question is, what do the tokens add? I guess maybe it's about seigniorage, but maybe, drawing that out, the distinction between, just purely taxing the transactions versus also having the token might be interesting. I have a second question, which is...
Should I do?
Go for that.
Both together, yes. No, give you a second question.
Sure. The second question is, in an environment where people, you started discussing, or you discussed the situation where agents would be different between the token and the CBDC, right? Now, in a world where you're indifferent, why would the individual quantities of the individual monies matter? Why isn't the overall money stock now what really matters? Aren't there many equilibria where that fraction, how that split between the two monies, can vary, is pretty arbitrary? So in other words, why is it necessary that the two money growth then have to be the same in that situation, right? If you're indifferent, right, and one money growth goes faster than the other one, well, you're just using more of the one money than the other money, but there could still be, the relative price could still be constant, right? And so that was another question that I had. That sort of laid it on down the paper.
Okay, so I guess to go with the second question first. So why are there not multiple equilibria? So if you had two private platforms competing, you have more difficulties. But here there's only one platform that's making a strategic decision, I guess, about the growth of the money supply. So in this case, if you had a situation where the currency holdings were split between the private platform and the public platform, the private platform would always want to slightly decrease their growth rate in money, so it gives a slightly higher return, so they can attract all of the currency. So there's not going to be.
But you're assuming there would be slight. How does money get into the economy? The platform just spends it. They're not taxing the current currency holders, right? So why would the return be higher? I mean, isn't one equilibrium if the growth rate is different, that the price of the currency are the same? It's just that the split between of the total quantity of money between the two monies changes over time. Why is that not an equilibrium? I guess it's a question just to trying to understand the mechanics here.
Because in this case, if we think about the platform, if we think about the portfolio decisions for what's going to pin down the currency market in the end, right? We have some expected benefit for holding a particular currency, right? But in this case, if there's full interoperability, there's no particular benefit to holding one currency or another. So the only thing you're looking at is the different return on the two currencies. And so it's a bang solution for these households. There's no disadvantage or advantage to holding a particular currency other than the change in the price over time. And so they just want to hold the one that gives them the higher return. There's no other role. If there's full interoperability, there's no other role for the currency. It's not backed by taxation. It's a pure fiat currency in this world. Does that answer the question or not really? You look more confused.
Yeah, maybe the question is really whether that equation still holds in the limit. I don't know, maybe that's the question. But I have to look at the details. I was just trying to understand because, you get sort of a Carrick and Wallace indeterminate result. Why don't you get that here? Maybe that's the nature of the equation if you're indifferent between the two types of currencies.
Because there's a strategic player in a sense that, let's suppose the dollar has 2% inflation tax, and then the platform would like to make a 1.99999 inflation tax.
No, hold it. You're indifferent between the currencies. They have a constant exchange rate. The inflation tax is on the total money stock.
So let's suppose both have you will be literally indifferent, and the buyers and sellers you split their portfolio holding 50-50. But then it's not an equilibrium, because then the platform has an incentive to cut the money supply growth rate by an epsilon. That
well,
kills
then
this
the
equilibrium.
theta could change. The theta could change over time. Then, no. I mean, it's maybe that's. Anyways, I have to look. I have to look at what drives it in the model. It's
Okay.
so
Okay. I think. Okay. It's a good question. Let me think about a reconciliation with the Carrican-Wallace result. Okay. So I will think about a reconciliation with that.
What about the second question, Jonathan? Or the first question?
The first question, yes. The first question was about the what is the role? Yeah. So we have a platform here, and the platform has some trading advantage, and they have different options for trying to monetize the trading advantage. And yes, ultimately, all these things end up being a tax on the people in the economy to try and monetize the trading advantage. And here we're thinking about the signage as one way of trying to tax that trading advantage. So they could get signage revenue. They could also get revenue directly from markups. I guess what we don't have at the moment, we've had a lot of questions about, is what if you open this up and allowed for something like a platform sort of participation fee or something like that, which I think is probably where you're sort of heading with this question, right? So I think the question we've had a lot, and I still don't have a very crisp answer for, I don't think, is what exactly is the difference between allowing the platform to extract this extra revenue through the signage rather than having a token participation fee, except to say that the token participation fee is not sort of dependent on these equilibrium objects in the way that the benefit of signage revenue ends up being. So I think that's the answer to your first question, right? It is the signage revenue that's the benefit. And I think the question is not so much how it compares to sort of the markup tax, as how it would compare to a token entry fee. And what is different about having this marginal benefit be sort of very market dependent? Does that address the question?
Yeah, no, that's great. Thanks.
There's one question in the Q&A box, and that's more a setup question. What is the reason for the platform to facilitate buying and selling intermediate goods and not in final goods? Perhaps some clarification.
Oh, I don't. That's really an assumption for convenience. I want to have a numeraire that's common across the economy. There's not a sort of deep economic reason for why I put the trading friction in one particular part of the market. You could also have you could have if you wanted, you could have platforms that are required in every stage of the market. It increases a lot of difficulty. I'm not sure it gives a hugely different economic result.
Okay, so I'm getting all these messages from Jen that we have a few minutes left. So if there's another question here or there, so please raise your hand or type it in the Q&A box. Check. So there's another question in the I have the same question as Harold. Why, if the private platform increases money slightly less than the public one, then it offers a higher return? There's going to be only one inflation in the economy, right? Question mark.
I'm not clear on this one inflation in the, I mean, there's the change in the, so it's a final goods numeraire. So there's a change in the price of the digital money and a change in the price of the public money. And there are two assets here, and you're holding the two assets, and there's two things you're balancing in your portfolio choice, right? So one is you have two different assets, and the prices of the two different assets grow at a different rate, right? I talk about that as sort of the inflation of the currency. Maybe better just to think of it as the growth of the particular currency price. You're also balancing that with a precautionary saving desire that if it turns out you really want to go to the digital platform, but you have a lot of money, you have to pay a high exchange rate fee. Or vice versa, if you're holding a lot of tokens and you really want to go to the public market, then you also have to pay a high exchange rate fee. And so the second thing that enters your portfolio choice is a desire to minimize your expected exchange rate costs. If you find that you really want to go to one platform, but you don't have the right currency. These are the two things that enter. And the only point I was trying to make is if you say there's no exchange rate cost when you go to the platform, then there's no precautionary motive to hold one currency over the other, because this expected benefit is essentially zero, right? There's no relative benefit of holding one currency compared to another currency. And all you're going to be looking at is the financial return, so the return on the price of the two different currencies over time.
Thanks, Jonathan. We're probably cut off any minute, any second now. So I would like to thank all participants for hanging out to the end and for participating. And particular all the panelists and speakers for being part of it. And as Daniel said, there's 30 seconds left. Let's just watch it and see how it happens as the clock goes down.
Thank you, Marcus. Thank you. Thanks, everyone.
Thanks again for all of you.
Thanks, Marcus.
It was
Thank
an
you very
interesting
much for your
discussion, and let's stay in touch. And you can always email us, all the authors, any questions you have, all the participants. Thanks for everybody.